All right, folks, and welcome to our webinar regarding navigating the stock market, where we're going to cover different approaches to make sense of the news, the noise, and how do you make up your own analysis and determine what's the current situation on the market. If you're a student, this is going to be a great introduction to having a systematic approach to making sense of the market. And more importantly, if you have an upcoming interview for investment banking, sales and trading, equity research, you can talk at a very sophisticated level about the market. So with that being said, let's dive into our presentation that we have, and hopefully this will give you more information to elevate your technical and your understanding of the stock market. So as I mentioned previously, what is the goal of the purpose? It's the first one is to understand how do you find best performing sectors, because that releases information of capital inflows and outflows in the market. Also, how do you apply a top-down approach where you understand what's happening at the macro and then focus or zoom into specific sectors and companies that have the probability of outperforming and underperforming, so that you can generate your own ideas, formulate your own investment thesis. And of course, again, if you're a student going through the recruiting process, you'll have a systemic or a process to pitching a stock and giving the interviewer a thoughtful response on your understanding of the overall market. Okay, so these are just the purpose of this webinar for you to take away. In terms of how we're going to tackle this, the first part will be navigating the stock market. We're going to break down as the first part of our presentation. Then the second part will focus more on sectors, market performance, and then headline news. Where do you find them? How do you make sense of it so that you can, again, create a concise perspective and view on the market with your own opinion? So let's dive into the first part, navigating the stock market. So the first thing that we want to understand is market sentiment. What is market sentiment? Well, market sentiment is the tone, is the psychology, and what investors' perception is of the overall market. Is the perception positive? Is it negative? Is it worrisome? Is there wide systemic risk where there's not enough confidence in the market? You need to know that as a market participant or as a professional in finance, because this is all tied to providing investment advice. It ties to your 401k, your portfolio. And again, if you're in investment banking, it affects the valuation of your businesses. If you're in equity research, it affects the price action and the performance of your company and what recommendations you're going to be giving to your investors. So it's very important that you understand market sentiment. Now, where do you get the market sentiment? What information is out there available for you to look at and disseminate the information, digest it, and draw your own conclusion? So some of the information out there is in reports like, number one, consumer confidence. This is created or produced by Michigan. They do a monthly survey and they report it and issue it to the general public just to see what is consumer sentiment out there. You could do a very simple Google search to get the information and also read articles written by news reporters on that information or the information contained within that report. Something else is very important that is widely used and that market participants pay attention to is the VIX. VIX is a measure of volatility. A VIX over 20 indicates that there is volatility in the market, extreme price actions move to the downside and to the upside, which means investors are probably being more conservative. They're probably hedging their portfolios to minimize any potential downside on the market. So understanding the VIX is very important. Also, you have New York Stock Exchange high and low indicators. This is more of a auxiliary indicator that tells you the health of the overall market. For example, if the New York Stock Exchange, if there are stocks that are making more highs, 52-week highs, than 52-week lows, that means that investors have a higher degree of confidence in the market because they're pouring capital into companies that are beating expectations and they're making newer highs. And the more companies you have making newer highs, the overall index like the NASDAQ, the S&P 500, the Dow Jones Industrial Average will also increase over time because those indices is a representation of stocks. So paying attention to the highs and the lows on the New York Stock Exchange, companies that are making 52-week highs and lows, is very important because it's a leading indicator of the environment within the overall market. Something else here that's important is known as the Commitment of Traders Report. You could do a simple Google on this report to understand what it is, but simply put, the Commitment of Trader Report gives us information on what the largest strategic corporations are doing when they're hedging positions. You also have large financial institutions showing in those reports what do they have in inventory. Are they net long or net short? Do they have puts or calls on the overall market? And then you also have farmers in several parts of our agriculture economy that are hedging their crops, whether it might be crude oil, whether it might be grain or cattle. Any commodity that is utilized in our economy will also be represented in the Commitment of Trades Report. And there are market participants that have created investment strategies around this report. So if you're someone interested in working at a hedge fund, in equity research, or in a trading desk, you should be familiarizing yourself with the Commitments of Trader Report and understand what type of investment strategy can be derived just by simply understanding that report. And lastly, of course, when we're looking at macro forces, the economy, we can look at things like weekly jobs claims, GDP, unemployment number, so that we can understand what is the economic environment that we're currently operating in. So these are 5 key points to look at when you're trying to understand the sentiment of the overall market. Now, an example of sentiment could be unemployment numbers. What is the U.S. current unemployment rate? Is it high or is it low? Given that unemployment rate, you can formulate your own opinion on what sectors are going to be performing better than others. And in an interview, you can basically provide a top-down approach on how you're thinking about the overall market, what sectors you think are going to do better, which companies you think are going to underperform, and it's all really driven by your unemployment rate numbers, and it shows your thought process. It's logical, it's rational, and again, you have a systematic approach to thinking about the market and generating your investment decision. And by the way, I'm gonna give you an example of that entire process on one of the companies that we were looking at within Romero Research, which is part of our analyst training program. And we're going to show you how that stock ended up performing once we shared the idea with members in our community. So if you stay tuned towards the end, we're going to show you that. Okay. So I think that's enough regarding market sentiment. Make sure you understand this, and again, do your own homework, do your own Google research in finding these key points so that you can familiarize yourself a little bit more and just be a step ahead of everyone else that hasn't taken the time to study this information. Now, to give you a more visual illustration and to be a little bit more focused with the information that you need when applying a top-down approach, or if I use myself as an example, I like to do this. I like to put a top-down approach whenever I'm thinking about the market. So the first thing that we look at is obviously the overall economy. Again, how fast is GDP growing, or how fast is GDP contracting? What is the unemployment rate number, and what sectors of the economy are going to be impacted by this? That's what happens at the macro, at the big level picture. Then once you understand that, you need to focus on specific sectors that will benefit or will not benefit given the current economic environment over the next 3, 6, and 12 months. That's then when we begin to narrow down and begin to do our homework and analysis on specific sectors. For example, of recent news, we've been noticing there's been a lot of capital inflow into the electric vehicle market. Companies like Tesla, companies like NIO, and other Chinese automobile electric companies manufacturers have been outperforming the market because there is a lot of demand for electric vehicles, especially coming out of China. And China is the biggest electric vehicle auto market in the world. Therefore, stocks that have a specific exposure to the Chinese electric vehicle market have been outperforming the overall economy. So right there, it gives you a top-down approach to what's happening with that sector, what are those specific companies, and how you can take positions to take advantage of that sector theme and capital that's being funneled into that sector. Again, I'm gonna show you this, how it played out at the end of this presentation, because what I just explained to you, it's something that we put into practice within our fund and other analysts within our program. So the economy, you focus on the sector. Something else here is understand press releases and the drivers, okay? Then you may want to focus on individual companies that make up that sector. So this is giving you a step-by-step process or a systematic approach or a formula on how to think about the market at the macro and then zero in to a specific company that, again, if you're interviewing, you could pitch. If someone asks you to pitch me a stock, or if someone asks you what sectors in the economy you like, or what's your opinion on the overall market, you could walk them through this process. Big picture, headline news, industry or sectors, focus on individual companies, and then if you are a little bit more sophisticated with understanding valuation methodologies, then you can focus on those methodologies. So take a screenshot of this, print it out, and go through this process, pen and paper, and start thinking what sectors of the economy you think are gonna do better, and what companies within those sectors are going to outperform, and keep doing that over and over until you develop that methodology in a deeper understanding that when you're talking about it in an interview or with a student club or even a competition or for your own portfolio, you have the process and you develop the right confidence. The more you do it, the more you understand the process. And again, like I said, you're going to develop confidence. And this is really what it's all about. It's about developing your confidence and your know-how so that you can do this independently and you're not dependent on someone else, including myself, when it comes to understanding this type of information. All right? So let's continue and talk a little bit more about economic data, right? We talked about market sentiment. We looked at a top-down approach, which is something that I use to make sense of the market, sectors, and then generate my own investment ideas. But when we're talking about economic data, to understand the macro, we can look at the cycles, right? Because as you know, that monetary policy, the Fed, they have major influence in the economy, setting interest rates. Are interest rates up or interest rates down, right? That's all comes down to their monetary policy. Also, at a political level, are taxes going to be higher or lower? For example, under a Biden administration, which sectors of the economy are going to perform best? So one thing that you need to understand is that our economy works in cycles, and those cycles are dependent on the current presidential administration, right? Because they have their own economic agenda. It's also set in part by the central bank, their monetary policy, and also Congress. What is it that they want to do? So every 4 years, you get to see different cycles within our economy that, again, you need to familiarize yourself with. And when we're talking about economic data, to be more specific with the key factors that you should concern yourself with, here are some, and let's pull this up right here. So we want to look at, like I've mentioned previously, GDP growth, unemployment rate. How big is the US economy? What about personal disposable income? Is it growing or is it increasing, especially during this current pandemic that we're experiencing? What about medium household income? What about immigration? What about interest rate policy? So at the macro, these big picture economic analysis allows you to draw your own conclusion. And of course, there's going to be dozens of articles by some of the largest news media outlets like Bloomberg, CNBC, CNN, Fox Business, MarketWatch, The Wall Street Journal, that have their own views on this information. But like I've mentioned before, it's about teaching you how to formulate your own independent opinion so that you can develop your own confidence, and then you can test You can test your thesis in the market with your portfolio or even a simulated portfolio, but most importantly, if you're a student, display or communicate that thesis and your thought process during an interview. Just a few things to touch on when it comes to the economic cycle, right? So, determine the current business environment. Analyze business trends and cycles. Is the economy growing? Is it declining? Or is it flat? So this is one initial question that will help understand which cycle of our economic cycle we're currently in. If you're looking at a specific industry, right? What are the questions or the variables or the data that you need to make a more informed decision about that industry? And these are simple things that you could do a Google search. So if you're looking at, for example, the restaurant industry in the US, as an example, how big is the restaurant industry? What is the market share of the top 5 holding companies? How fast is the restaurant industry growing? And what are the latest emerging trends within the restaurant industry? So these are the questions that you need to ask yourself when you're looking at an industry. And again, just doing a very simple Google search would help you find the answer. You put it in a presentation, you print it out, pen and paper, you begin to draw your own conclusion and connect the dots and see if the information makes sense, if it's rational, and if you can formulate an investment thesis, then you're on the right path, because it shows that you're putting a lot of thought and you're using data as your leading indicator to formulate your own opinion. And the goal of all of this is really to build your confidence so that when you are interviewing, you can talk about that at a high level. And for those of you that are already part of our analyst program, when we're discussing investing ideas, you already know that this is how we like to engage and have discussions about a company, about a market, using data behind your analysis. All right? So very important points under this slide. Understanding the economy big picture and using data to support your thesis. All right? So let's look at an example. Okay, where are we currently at? Let's look at unemployment. And how do you get this information? Well, one, you could do a simple Google search. Second, you could go to the Bureau of Labor Statistics to get this information. So what we're seeing right here, October 2020 was the latest report on unemployment numbers. And here what the headline was, or the main headlines from this government agency that tracks unemployment numbers. So as I read here, total non-farm payroll employment rose by 638,000 in October, and the unemployment rate declined to 6.9%, the U.S. Bureau of Labor Statistics reported today. These improvements in the labor market reflects the continued resumption of economic activity that had been curtailed due to coronavirus pandemic and efforts to contain it. In October, notable job gains occurred in October. See, this is important right here. Now we're using important information from this report. In October, notable job gains occurred in leisure and hospitality, professional and business service, retail trade, and construction. Employment in government declined. So during the pandemic, when there was the lockdown back in March, you saw a huge or a very volatile or sharp uptick in unemployment. We were around 4% or below 4%, as you can see right here on my screen, and it ticked to as high as 15, a little bit over 14%. I think it was as high as 15%. But now, because the economy slowly started to reopen, economic activity started to pick up, you could see the decline in unemployment. And now what sectors of the economy are benefiting from it or are recovering? Here's the answer. Leisure, hospitality, business service, retail, construction. So if you're someone formulating an investment thesis, okay, using this information, the next step would be to look at companies in the construction sector. Look at companies in retail trade. Look for companies in business services, leisure, or hospitality. Within hospitality, we might be looking at restaurants, hotel, casinos, anything related to leisure. Within the hospitality, you also might look at restaurants, establishments as well, even cruise line, or even airline. You may want to also look into those companies as well. Because if you have lower unemployment, that means that more people are working. They might have more disposable income, and they might want to take a trip and maybe take a little vacation to cool off or recharge their energy, especially during this pandemic, because it's really been a stressful year for a lot of people. So this employment report is releasing information that will help you formulate an investment thesis or an opinion. And again, for those of you that have an interview coming up, you can source this unemployment report number during the interview to validate your investment thesis, which you'll be surprised, a lot of people don't do this. You'll be surprised how many people don't do this level of analysis and use data to support their thesis. So I hope this example is useful to you, and I hope you learn how to interpret it so that in the future you could draw your own conclusions as well. So let's take a look at the next slide, which touches on economic growth, GDP. So this one comes also again from Bureau of Economic Statistics or Bureau of Economic Analysis. Here's the source. Where do you find this? You could do a simple Google search, or you could just go directly to their website. But this was third quarter GDP results, which was reported Thursday, October 29th. Now let's take a look here what it says. Real gross domestic product increased at an annual rate of 33.1% in the third quarter of 2020, according to the advanced estimate released by the Bureau of Economic Analysis. In the second quarter, wow, this is interesting. In the second quarter, GDP decreased 31.4%. And you could see it down here. You could see the drastic, sharp decline due to the lockdowns, pause of economic activity, but then you see the sharp snapback in recovery from GDP once we started to reopen again, and especially other states. You can see the activity right here. So you could use this information to draw your own conclusions that we are in a recovery phase within our economy. And of course, with a lower unemployment rate, you saw which sectors are benefiting from that or have the potential to grow the fastest because they've come in from a very severe position. Let's see right here, this second other point. Let's see if this is important. The GDP estimate released today is based on our source of data, incomplete, source agree. Okay, not much information released here. But you could use this table to see where we're currently at within the economy. So we are in a recovery phase. In the third quarter, GDP grew by 33.1%. And in the second quarter, GDP declined 31.4%. Use this information during your interview when someone asks you, what do you think about the economy? Is it recovering? Is it declining? What's your view on it? Well, now you have the data to support that. If someone asks you, what's your favorite sector? Pitch me a stock. Well, because of low unemployment and the rebound in GDP, I believe that leisure and hospitality will be one of the best performing sectors. Therefore, I like XYZ company because they have a higher growth rate and they've actually put the right proppers and measures and protocol in place to withstand any other type of pandemic moving forward. You have a top-down, a narrow, and a specific company. A top-down, narrow approach to generating your own stock investing ideas, especially during an interview, at a student club, in a competition, or just simply if you have your own student portfolio. Okay? So I hope this information is useful and valuable to you on how do you use it to pitch and formulate your own idea. Again, take a stab at this yourself. Get the information, print it out, and with pen and paper, start to connect the dots. Start to think and activate or access that creative side of your brain that would begin to help you understand how the economy works, how so many variables are connected. And it's kind of like a chain reaction that if we have higher interest rates, it's going to impact the housing market, is going to impact newly starts, is going to impact mortgage applications, and the number of homes being bought or sold. So think about that, okay? Put that into practice in pen and paper, and you'll be surprised how creative you get when you start to put this into practice, all right? So let's continue with our next slide, where now that you have a better understanding of top-down, looking at economic data, where to find it, and begin to use those reports to look at specific sectors, there's another way of doing this, and that is by looking at ETFs, looking at the broader averages that is a barometer of the health of the overall market. We're talking about the S&P 500, the NASDAQ, and the Dow Jones Industrial Average. So we can start by looking at the economy, which we did. Then we can look at indices, like I've mentioned, the SPY, which represents the S&P 500, the NASDAQ, which represents the technology sector of our economy, then the Dow Jones Industrial Average. These are the three most watched and broadly used ETFs on the market that you can, again, use as a barometer or an indication of which direction the economy is heading. Once you look at those ETFs, look at press releases, okay? Press releases that would give you more clarity, that would give you more information on how to make sense of it all, really. Then after that, you may want to look at specific sectors. And those specific sectors could be consumer discretionary, could be consumer staple, energy, financials, healthcare, industrial. I mean, this basically represents the entire US economy. Okay? And then lastly, once you find a company, look at valuation. DCF analysis, comparable trading analysis, whichever valuation metric or valuation methodology is the appropriate one to use for that particular company. All right? So let's continue now to give you a more clear example of what this really represents. Okay, so when we're looking at the market right now, year to date, when you look at the S&P, the NASDAQ, and the Dow Jones Industrial Average, you see quite clearly that the NASDAQ is the sector that has been outperforming the rest of the market. It's up 31%. Then you have the S&P 500 up 11%, and the Dow Jones Industrial Average up 2%. So why is the NASDAQ outperforming the rest of the broader averages? Let's think about this. So the NASDAQ, of course, is weighted tech. And there are 3 or 5 tech companies that have actually outperformed during the pandemic, especially during the lockdown period. And one of the biggest winners during the pandemic has been Zoom. Zoom is a tech company. They are included in the NASDAQ. You also have companies like Google. You have companies like Facebook, Amazon, Microsoft that are heavily weighted in tech. And those companies during the pandemic, when the economy was locked down and restaurants were closed, tech was still operating. They actually benefited from the lockdown, and people were working from home, communicating in this format. Therefore, capital started to flow into tech. And that's one of the reasons why tech has been outperforming the market. When you look at the S&P and the Dow Jones Industrial Average, these are covering our construction part of the economy, is looking at restaurants, casinos, airlines, energy. The broader economy has been lagging, okay, but tech has been outperforming. And it's quite clear when you look at the data like this. Another important point to look at is the overall size of the US stock market as of June is estimated to be around 35.5 trillion. Okay, and this is after coming from a severe decline in March. See here, we declined sharply and then we recovered. Now, why did we recover down here? Well, this was, of course, due to the stimulus that was passed by Congress. I believe the time that they passed the stimulus, it was about $2 trillion. Also, the Fed, they started to inject liquidity, they lower interest rates, and they started to buy bonds directly in the market. So they put a floor on the bond market in the US, and the US bond market is estimated to be around $8 trillion. So that was massive liquidity injected into the economy by Congress and by the Fed that put a floor on the market. And that's what you're seeing right here, and the reason why we started to recover from that point forward. So this is part of the story that you need to understand from where we are at right now, where have we come from, and what the next 6 to 12 months may look like, all right? So when we look at specific sectors now within the economy, I like to look at sector spiders. Sector spiders represent the major sectors of the economy and how things have been performing year to date. So a couple of the most notable sectors to highlight, obviously energy, financials, real estate, and technology. When you look at energy, they're the worst performing sector year to date. They're down 53%. So if you go to an interview and you're pitching energy, you better know this information. If you're pitching energy because you like it for whatever reason, but if the reason that you're coming up with, if it's not backed by data, if it's not supported by a high growth economic environment, then you really haven't looked at all of the possibilities or the variables and the information that you need to make a conclusion or pitch energy. So you need to understand that before you just pitch a stock or an industry. Same thing with financial. Financial has been the second worst performing sector within our economy. And if you're bullish financials, well, why is that? Are you bullish because of interest rates? Are you bullish because of a Biden administration being more favorable to Wall Street? Are you bullish financials because you think the economy is going to open up again, it's going to go into a growth cycle, and people are going to be borrowing more money, including corporations, which is where banks usually benefit from as well? You need to understand this process so that you can know what the drivers are within the sector. Now, which one has been the best performing sector? Well, it's technology. You can see it right here. The ticker XLK is a basket of technology stock, which represents the technology exposure. And here it is, up 32% year to date. Now, within this ETF, there are components. There are stocks that have also outperformed, and you can pick from that ETF stocks that you may like, stocks that you're very familiar with. So let me give you an example so that you can see exactly what I'm referring to. So let's pull up right here our ETF, okay? And this is, of course, our YouTube channel. Make sure you subscribe and take a look at some of the other sophisticated stock analysis that we've done, which again will help you better understand this process. But let's go to Yahoo Finance, and I'm going to show you this. So if we go to Yahoo Finance and we type the ticker symbol XLK, we can get access to the top 10 stocks within that index. XLK. Okay, search. Click OK. And there is something here as one of our selections known as holdings. If you click on holdings, it pulls up the top 10 holdings. Here they are. So you have Apple. Apple is 23% weighted. You have Microsoft, 20.5%. Then you have NVIDIA, Visa, MasterCard, PayPal, Adobe. So if you're bullish tech, you could pick any one of these stocks that you think has the right metrics, the right growth drivers, and the sector is growing and is going to benefit these companies or any one of these companies that you believe will continue to grow, given the current environment for that industry. And of course, they have a better product that is in demand. They're outperforming and beating the competition. And operationally, the businesses run more efficiently because they have a higher EBIT or gross profit margins or net income margins than everyone else in there. So this is a useful tool for you to utilize when you're looking for stock ideas or you want to find the constituents or the top 10 companies that are made up in that ETF, okay? So with that being said, we now look at market impact press releases. So we talked about the economy, right? Top down, their growth indicators, economic data that we can use to come up with our own thesis. Then after that, we looked at the averages, ETFs, that tells us how has the market been performing year to date, and then what are the worst or best performing sectors. Then once you have that understanding, look at press release. If you're not able to see the bigger picture, just do a simple Google search for any one of these headlines. U.S. presidential race, U.S. or China trade war. Look at what other journalists in the media, in the financial sector, what are they saying? How are they interpreting the information? And you could get a lot of good information and different perspective as well when they're writing their articles. You may also want to do a Google search on Federal Reserve monetary policy. Are interest rates going up or are interest rates going down? What about company earnings, which have been the companies that have outperformed or reported better than expected earnings number? You can also Google government spending. natural disasters. I mean, this is more related to COVID. Mergers and acquisitions. For those of you interested in investment banking, what are the latest M&A activity, or how has the M&A environment been in 2020? And of course, industry emerging trends, obviously within 2020 has been virtual. Working from home, virtual online learning, and even virtual communities have started to pop up due to the coronavirus. And of course, Zoom has been the tool that has allowed all of this to be possible, just the same way we're conducting this webinar today. And then of course, try to understand different asset classes. So this right here would help you understand the bigger picture. What is the information or the perspective that is driving a specific sector? And this is very important, especially at the student level, when you're trying to learn and understand how the sector or the economy really operates. And again, it gives you different perspective. So, like I've mentioned earlier, let me give you one example of a top-down approach that we took in the electric vehicle sector, and how we actually bought the stock and it turned out to be a profitable trade idea for us. So here, let me pull up our platform. Okay. Let's go to our feed. And by the way, folks, this is our own unique platform that we've created for our analysts in our community. It has a very rigorous training module. It has access to connect and speak with other alumni, and it also has its own newsfeed. So here's the thesis, right? At the big picture, okay, top-down approach. So we were looking at the auto sector, and I posted here, I'm doing research on China's electric vehicle market. I recently came across Li Auto, a Chinese electric vehicle company. They are growing pretty rapidly and will be announcing earnings November 13th. Which was this past week. If earnings are good, I think the stock will double in price. Look at NIO, ticker symbol NIO, another Chinese electric vehicle company, which is over 100% year to date. In other words, they were up over 100% year to date. Tesla is up over 300% this year. And don't forget about Nikolai, which more than doubled while the CEO was running some fraudulent operation where some of the press releases that they issue was actually not factually true. So they were construing and giving misinformation to the investment community. So NIO was a stock that was a combination of hydrogen and electric vehicle, but the technology perhaps wasn't what the CEO was saying, and also the number of sales that they were anticipating was not factually accurate. So the stock more than doubled and tripled in a short period of time. But once the information started to be released, the misinformation, the stock basically just declined more than 50%. But still part of the same theme, part of the same story of electric vehicle. I continue. I think Li will follow the same story and price move as other electric vehicle companies. I own shares at 21.50 with a stop loss at 19. Below are some of the links to my sources of information. Let me know your opinion, what you think, pulling up the data from the Chinese auto sales market. Okay, so when you see this post and then you see the level of engagement from other analysts in our community, Julio gave his feedback, Yusuf also waited and commented on it, Erin also gave her perspective, Michael gave his perspective. So when we see the performance of Li from a top-down approach, the industry, the thesis, the theme, the companies, and then an actual execution behind this thesis, here is how we perform. We actually have our own chart within our platform as well that allows us to see this. So let's just load up. Let's put up here the ticker symbol of Li Auto. Here it is. And this is just pretty cool. So when we first came up with the thesis, it was right here, right in late October was when I actually bought the stock. So this was below $22, okay? And over the next 2 weeks, the stock tapped out at $40 once they reported earnings. So we documented this. we executed the idea, and now you got to see how it performed, how it materialized. For those of you that are interested in equity research and also working at a hedge fund, I just gave you the process of thinking about a sector, a theme within that industry, and finding the companies that can potentially double in a very short period of time, and also using data to validate your investment thesis. Folks, this is the type of analysis that we're doing within Romero Mentoring, especially with our analyst students in the analyst prep program. They get access to our community and all of these things that we're doing. So with that being said, folks, I'll turn it over to you. And I guess I'll open up this time now for Q&A. If anyone has any question on any of the methodologies, on any of the concepts that I've covered, now is your opportunity to type your questions. So let's see right here if anyone has any questions. Okay. Yes, yeah, it's being recorded and it will be uploaded into the platform. Okay. Let's see here. Any other questions? No? All right. Well, I guess this was straight to the point, short and sweet, but a lot of valuable intake for you to digest and really understand this process. So just to recap. Okay. In terms of conclusion, learn how to organize information and understand market cycles. Okay, number one, major indices and sector-focused funds like ETFs, like I shared with you in the previous slides. The S&P 500, the SPYs, the NASDAQ, the Qs, and the Dow Jones Industrial Average, the Diamonds, ticker DIA. And then don't forget to look at the sector spiders ETFs that reflect the performance of every sector within the economy. Also, don't forget to look at economic data. I gave you an example with unemployment rate, and I gave you an example with the most recent GDP report. In addition to that, make sure you use Google to analyze and look at press releases to give you more information and give you different perspectives to help you understand what's really happening in the economy outside university, outside of the classroom, because sometimes you guys are focusing on different topics and learning different concepts and methodologies not relating to finance or the economy and investing. So this helps you understand what's happening and maybe have the pulse within the market and in our economy. What are some of the useful websites? Wall Street Journal, Bloomberg, CNBC, Yahoo Finance, like I shared with you. How do you find the components of an index? Drush Report, stock charts, and sector spiders. Let's see here, Anna, because you explain things clearly. Okay, well, I hope I've done a good job really explaining things, the process and where to get the information so that, again, you can do this on your own. I mean, it's about teaching you the process so that you can become an independent thinker. And then later, if you're part of our community, share your thoughts, share your ideas, and maybe I can learn something from you, okay? Let's see, we have one right here from Philip. Does this apply only to the equities market? Any tips on equity options, fixed income markets? Thanks. Actually, it does. In a way, it does, Philip, because if you're looking at, let's say, options, right? We could have done options on this idea, on Li Auto, right? We could have bought options on the stock right here and anticipate this move, okay? You could do the same thing on the overall market. So for example, if we look at the S&P 500, okay, if we zoom out and we do a bigger time frame, let's say weeklies, right? So you can see where the market is at right now. We had that recovery from March. We're all the way up here. If you believe that this is a topping point within the market and we are due for a pullback, then you could place a bet and buy a put option. A put option would increase if the market rolls over. A put is essentially another way of shorting the market. If you're looking at fixed income, is the economy going to continue to recover? If the economy recovers and gets into a stronger point, what does that mean for corporate America and corporate bonds? It means that at the top line level, companies should be generating more sales. It means that they're going to generate more cash flow. It means that they can service the debt and pay down their bonds and contractual agreement, which should be perhaps bullish for bonds. So let's take a look at fixed income. Let's look at TLT, which looks over the 20-year treasury. Okay, TLT since September has been in a bullish run. So if you believe that TLT will continue to go down because it's fixed income, then you can go ahead and buy a put, or you could short the overall sector. Okay, so this is one way that you can apply that methodology or that process to different asset classes in the overall market. So you don't necessarily need to buy bonds directly. You could do it through other tools like an ETF index fund, like the TLT. I hope that answers your question, Philip. Okay? All right. All right, folks. Well, I'll end the session here. I hope this was informative. I hope you got to see how I look at the markets from a top-down approach, how I use economic data to just help me understand market sentiment, then how I look at different index funds or ETFs to see the performance year to date, then how I look at specific sectors, how I look at companies, and how I just like to connect the dots to generate my own investment thesis. And again, I hope this process helped you because you can apply this yourself and do it, right? Take it as an exercise. And if you are able to figure it out, then kudos to you. It should help you build confidence, and it should help you with upcoming recruitings and interview questions. All right? All right, folks. So with that being said, I'll end the session here, and I'll see you in the next one. Take care. You're welcome. Bye-bye.